Hi there, everyone, and welcome to On Track. It's the 28th of January, as I recall this. So we're going to talk about what's happening in the markets right now, which is we're in the middle of a correction, a short-term correction. I'm going to talk a lot about that. I'm going to take you through performance to the end of December, which will show the full year for 2021. Obviously, that's going to be a little bit out of date, but I'll talk through what's happened in January as well so far. Happy New Year. Just a quick apology. I know some of you didn't get the link to our December video, which was sent out just before Christmas. You can find that on our website. You'll find the December edition if anyone wants to go back and look at that. So my apologies. We had a little email glitch in the way that was sent out. So enjoy this one. Feel free to go back to that one as always. Let's get into it. So as always, just a general advice warning. This video is designed for clients of McGregor Wealth Management, particularly those that use the CARE methodologies and portfolios. I'm going to cover today some of the latest economic news, put it all into context, talk about what's happening in key markets, market returns. It's actually a COVID-free issue. I'm not going to talk about COVID stats at all, where none of the market movements are due to COVID. We're coming out of that as the world starts to look at what's happening next. There's going to be a lot more facing what's actually happening in the economy, etc. So I don't want to diminish COVID, but I'm sure you're all sick of it like I am in terms of talking about it and dominating our world. But I'm going to talk about other stuff today, including continuing to talk about behavioral biases. I'm going to focus on one in particular that's very relevant at times like this. Volatility is back, and I've added there, of course, share markets are naturally volatile. It's the normal, expected, and inevitable process. I'm going to have a look at a bit of the history of that volatility, what to expect, and talk about how to keep our heads in times where the market comes down a bit. I'm going to talk about property predictions and whether it's very smart to make property predictions, and talk about some of the latest predictions from some people and whether it's a good idea to listen or not. And as always, be trying to put it all in perspective. So in terms of some of the news highlights at the moment, markets are correcting, down by about 10% in Australia as we speak, although I'm recording this on Friday the 28th at 12 p.m. I started putting some of these slides together last night, and some of the rest finished this morning. So you'll see the difference when I go to some of the market slides about where we're at. But I've shown two slides here on the front. The top one here is NASDAQ, because this correction is being driven by overvalued tech stocks, particularly in the US. Australia hasn't copped it as much because we just don't have as many tech stocks. We've got some like Afterpay and Xero and a few others, but we just don't have as much. So similar to the tech collapse in 2001, it's unlikely to affect us as much. Now, what's driving it is the fear of interest rates and the withdrawal of stimulus. As I've talked about in previous videos, the US Federal Reserve, Australian Reserve Bank, and all the federal banks around the world have been busy holding interest rates down to allow for a recovery from the COVID lockdowns and economic impact. And they've also been busy with money stimulus. That means printing money, that means buying their own bonds. So there's been a whole lot of money go into the world, which prevented us from having a depression. And it meant the world's kicked on reasonably well in terms of the economy. But now all of a sudden the market's freaking out a bit, but that support is going to stop. Now, that is quite common. I call it the good news, bad news story. So when you start to see good results of growth and potentially inflation, because keep in mind, for the last decade, we've been trying to get some inflation and just couldn't get it. Inflation was low. The markets and the governments don't like super low inflation because it can lead to people, it can lead to deflation and disinflation, which is not good for the economic cycle. So they've been trying to get inflation. We've got some now. In Australia, the latest numbers, which have just come out, have us at about 3.5%. We're not copying it as much as the US, which is up around 7.5%. Now, keep in mind, these are current numbers. You've heard lots of people talk about whether that's transitory or temporary, or whether it's inflation's out of the bottle and it's coming back. No one knows for sure. There'll be some bits of both in that. In other words, some things will be transitory. I've talked about that in the last 3 or 4 editions. And some of it will be permanent. We don't know how much that will be at this stage, but that's what markets are jumping at the moment. So fear of interest rates going up. And when interest rates grow up, it affects valuations, particularly of growth companies. So some companies do better when interest rates are going up, and some companies do worse. The ones that are perceived to do worse are the ones that are high growth stocks. So that's why tech stocks are in the brunt of this. And you can see I've got 2 charts here. So NASDAQ up the top. And NASDAQ is the top 100 non-financial companies, or 100 non-financial companies in the US, but it's generally a very tech heavy. It's about 35% tech. And you can see it's down from a top of about 16,000 in November. And it's down around just above 13,000. So down around 20-ish%, which 20% is the borderline for what they call a bear market. So NASDAQ, tech stocks in a bear market. But if you drill under the bonnet, and I've got some news there about how, this week there was really strong profit numbers reported out of the US from Tesla, Apple, and Microsoft. Now, these companies are doing incredibly well. They've all been hit as well this week, but not by as much. So the top 10 companies in that NASDAQ index really dominate. About 40% of the market includes the big guys: Facebook, Google, Amazon, Microsoft, Apple, etc. But it's the rest of it which has copped it even worse. So there's a fund in the States called the ARK Fund. So it's an innovation and technology fund. And you can see it peaked back in February of this year at nearly 160, and it's down below 80. So a drop of more than 50%. Now that's more than a bear market, that's a crash. So that pointy end of the technology world has been in a crash. Now that doesn't affect us as long-term investors in a much broader market, but it helps to explain some of what's going on at the moment. I'm going to break that down a bit more and talk about what you should be thinking about when you're hearing the news about all this sort of stuff. Not much change in a lot of the key numbers here. You'll note a big one, though, is the 10-year government bond yield in Australia has crept up to about 2%. Now, when we say crept up, so it's going up, that's causing markets to come down a bit. But you've got to remember, 2% is still incredibly low in the long-term cycle. And the bond yield traditionally would be 1% above inflation. So that's the market's predicting still very low inflation, even though we know it's it's come up at the moment. So the markets are still kind of saying it's temporary in the bigger picture. Time will tell whether the markets are right, or the journalists, or everything else. We've seen indications from both US Federal Reserve during the month, and from we expect when the Reserve Bank has their meeting and announces their stuff next week, that the chance of interest rates going up is probably going to happen sooner rather than later. Now, once again, this is good news, bad news. Why are they putting it up? It's because the economy is growing better than anticipated post-COVID, and while that's a good thing, the market gets a bit scared. It's the old taking away the punch bowl that the market's got addicted to in the last few years, and markets have gone up with all that stimulus. So let's dive in to a bit more. So portfolio returns, and keep in mind, these are to the end of December, so now the full year. And it's almost a textbook set of numbers when you look at the 5-year numbers, and our targets shown there on the right, but 5, 7, 8, 9, 10% 5-year numbers, depending on a risk profile, slightly ahead of the long-term averages, but not by much. Very similar for 3 years, although pretty good. 1 year higher, but 1 year, of course, includes a lot of recovery, although that's we're now kind of out of that COVID sort of recovery phase. It's coming up to, in March, it'll be 2 years since the COVID crash. It started to drop in February. So we're going to see some changes to the numbers around that in February 2020, when Wuhan was hit, and then it hit the rest of the world in March, or started to creep out, and that's when markets dropped 36%. Our portfolios have done incredibly well. They'll continue to do well. because of that incredible level of diversification, etc. But you'll see the genuine edge portfolio, it started to come back a little bit, still a spectacular 25% because it does have things like artificial intelligence, robotics, and things like that in the portfolio. The investment committee met on last Friday, and we judged that the market was fair value. It's probably slightly under fair as we speak today, just given the market's dropped more since then. When we made that decision, the S&P, the ASX 200, sorry, was about 7,200. It's about 6,900 today. It's on an up day as we speak, so we probably have the market a little bit cheap at the moment. It's a good shopping time if you've got extra funds to invest, but I'll talk more about some of the timing of that. Our context, I'm going to unpack a little bit of this a bit more, but this is never more important to understand where we are. I talk about the wall of worry and the boom bust wall of worry cycle. This does not look like a bust. A bust, I talk about more than 20% correction. We're seeing that a little bit in the extreme tech side, but not in the mainstream markets. And Australian market just this week hit the correction level of 10%. But corrections are common, and they exist absolutely in the wall of worry. And in our case, it's helped bring our assessment down from just above fair to just below fair. But corrections are a normal point. I'll dive into those in a minute because I want to talk about corrections and our behavior in corrections. So once again, these are the things that we want to be wary of. So these are the big bear markets where the market drops by more than 20%. They're quite rare, as we see. So since 1900, we're only talking about 9 of them. All of them, except for one, were caused by crazy booms that eventually led to a bust in our wall of worry model, and then a recovery and back into the wall of worry. The only one that wasn't was COVID, where we had a very quick crash, a recovery, and then if you look at where the market is, and this was a chart done before today's recovery, so the market's dropped back to just before COVID, but about the end of 2019. So as we speak, the market's at about those levels, but it's obviously been on a little bit of a roller coaster where it dropped and has recovered. And this is just the price. This doesn't include the dividends. And keep in mind the Australian market, which this is, has paid a healthy 4 to 5% dividend during that period with franking credits. So that return alone is far superior to the return of being in cash for that whole time, which is what the bears and the scaremongers would argue, but cash has returned about 0.1% per annum during that time. So the pendulum has swung back a little bit in our mini wall of worry. There's a bit of fear in there, not amongst our clients, hopefully, who are well trained in the normalness, bad word, but not the normalness of volatility. And keep in mind, volatility is the price we pay for getting good long-term returns. We've got to have the occasional volatility. So I thought I'd have a look at volatility today and look at the last 38 years. The 38 years was 2 parts. One, that's all this free chart on Yahoo goes back, but it just happens to coincide with my time in share markets exactly. I started work in 1984 for an investment management company. I'd been with Commonwealth Bank before that. So this represents the 38 years that I've literally been working in share markets. And what I've done here is I've shown, this chart just shows the 1-year results in each of those years. A green bar is a positive year, and the little dash to the left is where the market opened. A little dash to the right is where it closed. So if you see my cursor in 1987, the market started off and it was up an incredible 70% that year. One of the biggest, it was the biggest year ever for a market to go up. But the next year it opened up, but it closed high. And you can see where it opened the next year because the open and the close match, but it closed about 17% lower. But the range of the drop there was 50%. So in 1987 in October, the share market dropped by 50%. But it had gone gangbusters for the previous 3 years. And you can see this line here that shows the slope of that increase. Fast forward as we wobble through the wall of worry with more normal returns, and you'll see the odd red bar, which are the negative years. Although it just shows it's down. Have a look at this year back in about 1997. The market closed just below where it opened, but quite a range. So one of the messages here is that 10% drops are extremely common. You'll see them almost every 2 years on average, and not far away from every year, top to bottom. So there's many years and if I go back to about 5 years ago, I think that's 2017, the market opened here, closed there, went up by a respectable 8 or 9%. But look at the range that it covered during the year. So somewhere during that year, there was obviously a 10 to 15% correction, well since recovered. So the last big crash was across 2007 and 8, the two red bars here. And you'll see once again, the slope of that increase in the 5 years leading up to it was pretty phenomenal. This is a log chart, but you'll see that market going from 3,000 to 6,000. So doubling. We always get a bit nervous if the markets double in 2 to 5 years. At the moment, the ASX 200's taken 8 or 9 years to double, so we're not in that craziness. And you can see that by the slope here. It's a much more subdued slope when you look at the last 8 years. It's a very normal market where the market's taken its time to go up rather than that rapid pace of the others. And that's why, I feel, comfortable is probably the wrong word, but comfortable thinking that we're in a wall of worry here. We're not in a boom bust scenario, but rather a correction. Now, different for different markets. And that's why you've got to be careful looking what you're in. But this is the Australian share market. The US market's experiencing a slightly more correction. Technology, a bear market, and extreme technology, absolutely a crash. So those that were punting on high-tech stocks with a future. And that's what I want to talk about, another concept today, or two. Firstly, another behavioural bias, which I've been talking about for the last few months, and these are things that that explain why investors get a lower return generally en masse than the investments they invest in, which always sounds weird. But an investor in the Australian share market, if they'd left their money alone for the last 50 years, would have doubled their money every 8 or 9 years and been very happy. But the average return investors get is much lower than that because they zig and they zag. They panic at times like this. They gear up when the market's going gangbusters, and they turn from investors to traders or speculators, and I'll talk more about that in a minute. But loss aversion is one of these things. So loss aversion it's one of these biases, and it describes why that we experience the pain of losing twice as much as the pleasure of gaining. So we're more worried about losses than we are of gain, even though that's not logical. So we fear the loss much more, which means people make sillier decisions when markets are down. And as I said, markets haven't gone back very far. I'll show you exactly how far back in a minute. But it's got the media, and I'm going to talk more about that, buzzing, and the media loves nothing more than to fearmonger and get your attention. And we've got to know the difference about what we're doing with our money. Sometimes we're saving up, and when we're saving to spend, or we're saving for a rainy day. So we tend to do that in cash. We don't get much of a return at the moment, but we know that's the price we pay for not having to worry about volatility. All the money we invest for our clients is investing. We do carry some reserves for our clients in more like saving things, but we're investors. We're not speculators. We're not traders. We're not gamblers. And what we're seeing at the moment, and you'll see the chart I've shown on this page is a Bitcoin chart for the year. So the wild roller coaster of Bitcoin, it went up, it crashed, it's gone up again, it's crashing again. People speculate, trade, and gamble in that market. It's very hard to invest in Bitcoin because it doesn't produce any income. And my definition, and happy for people to disagree, but my definition of an investment is something that produces income. If you're buying something on the hope that it goes up, then that's speculation. Or if you're trying to buy here, sell there, that's kind of trading. And they're not things that we do. They're things that other people do. And at the moment, we're seeing the unwinding of some of the more speculative end of the market, but not something that concerns me greatly. My only concern at times like this is not what's happening in the market. It's what investors might do. So my worry is not about our portfolios. They're rock solid. They're going to continue to evolve well. My only worry is people make silly decisions based on the media or short-term news that they make are bigger than it should be relative to history. I'm going to focus a bit on the media out of all of these mess ups. The media's had 2 years where the masses have been glued to their screens, watching daily briefings on that word I'm not going to talk about in this one. So the media's had it good, and they weren't having it so good beforehand. People were tuning out. They were tuning into all sorts of new media or their own thing. So all of a sudden the media is back. Now, they would be petrified that as we come out of the era that we've been in, they're going to lose their power. So they're currently looking for new things to scare you with. And one of those new things at the moment is inflation, interest rates, and all these things. So the biases we've talked about recently, one of those is recency bias, the fact that we tend to focus too much on things that are happening now and we underestimate their importance. And you'll see this bottom chart, the index chart that sits in the office, which you've seen many times, but it shows the dark blue line of the share market going up. Now, the reason the share market goes up in the long run is quite simple. It's called evolution. We as a species continue to evolve and get smarter and better at most things. We still get dumb at some things, but evolution is perfectly reflected in the share market. It's why the share market goes up all the time, because we make things quicker, faster, better. That is reflected in capitalism, which is reflected in the share market. But as I go back a couple of charts here to that wall of worry and the pendulum, while the long-term market goes up because of that evolution, that natural evolution, the short-term market fluctuates due to the psychology of the market. And that's why occasionally we get that, we're in the wall of worry, but occasional boom and occasional bust. Your success as an investor depends on not making bad decisions during booms, busts, corrections, and that sort of thing. And that's why we talk so much about these things. And that's why it's more important than ever to ignore the media as your advisor. As I've said before, you won't find a journalist or a forecaster who actually has to manage money. There's a very prominent Sydney fund manager who used to be a stockbroker newsletter. His name's Charlie Aitken. Charlie's a fun guy, but he's a Sydney socialite who's in the news at the moment because he and his wife have split up. But Charlie was one of the top newsletter writers in Australia over the last decade or two. So people love to buy his newsletter and trade off it. Now, newsletters are kind of like horse racing tipsters. They're not accountable for how their portfolios go. And about 3 or 4 years ago, Charlie decided he would get into funds management, and he's been managing portfolio. And to put in perspective, at his peak, he was managing about $200 million in those funds. And it never got to more than that because he didn't actually do that well. In fact, over the last year, his funds were down about 42%. So that ability of headlining and making predictions, which sounded all exciting when it was written down once a month, didn't translate into being able to manage money. You will not find journalists that manage money and that have been able to manage off their predictions. You just will not find them. They don't exist. Let alone the journalists, young journalists who are writing these articles, who have one job from their editor, and it's not to report factually, it's to make you watch. And bad news does that. So you're going to see more and more of those headlines. Our portfolio strategies are designed completely the opposite of that. They recognize the reality of long-term history. They recognize that if you do smart things, you get good results. That's why we talk about not messing it up, avoiding those bad decisions and that bad behavioral thing, and having everything based on your plans. So let's have a look at what's in the market. And I I cut and pasted these Aussie charts in before the Australian market opened today. So you'll see the chart here and how quickly suddenly that's fallen off the cliff back down to around that 6.8, 6.9 level. It's bounced back today, and as we speak, the market's on an update. And by the way, it's 12.29. At the end of the day, it might retreat again. During volatile times, the Australian market often retreats a little bit on Friday as the speculators get out because they don't want to hold open positions over the weekend. For us who are long-term investors, that's completely irrelevant because we're in it for the long run and not the short-term movements. So a significant correction. We're in the 10% correction phase now. We'll see how long that lasts. I tend not to make predictions except to say, you know what, the market's at a reasonable value. I'm very happy to be buying and for our clients to be buying at this level. It's cheaper than it was, and that's all we know. Still ahead for the year so far, and we've had the benefit, as I said, of 5%, nearly 6% with franking credits, dividends for the year. And you'll see when we look at that 10-year chart, despite the COVID dip, it's still been a pretty good decade where investors have done well if they've stuck with their plans. And we'll see where the month ends up when we talk next month. In the US, much the same, numbers slightly bigger than 10%, but the same story. And look where the previous year was to the end of December. It was up 31%, so it was ahead of schedule. The 5-year return was 18%, so the market had doubled in about 5 years, which often means it's ripe for a decent correction, as it's done. We hold US shares, we hold Australian shares. We're very diversified. The downs are temporary, the ups are permanent, and that's because we are, and that's important because we are long-term investors, not traders or speculators. US small caps, which had an even bigger year last year, 35%, is copping a little bit. And we hold this in the portfolios in a smaller amount because it is a more volatile market. So it's given up, still up for the year, by the way. So, it's still done better for the year than the Australian shares. It's just been a wilder ride, and it will contain some of those tech stocks, but it's not overly tech heavy. Global leaders, same thing. This includes, as we look down the left, Apple, Microsoft, Amazon, Facebook, or Meta, as they're now known, etc. And yeah, it's had a decent correction as well. Not crazy, but you'll see here, I copied this chart in a couple of hours ago, and you see the Aussie market bouncing this morning. So it's already starting to look like it's coming back. We'll see what happens in the next little while. Emerging markets has been very subdued, partly because of stuff happening with China there. So emerging markets is still in a not a great place for the year. We think emerging markets are actually starting to get really cheap, and they're a very important part. They do outperform in the long run. They do add a very important diversifying factor. And you'll see in the last 10 years, they've still provided a very decent return, up around the 8-9%. So an important part. And they bounced this morning as well, as markets bounce. Gold's fascinating. It often does the opposite of everything else. So gold's still pretty much zero for the year. Hasn't really done much at all. And keep in mind, you get no income from gold. So gold's in the portfolio as an insurance factor. It had gone up when the share markets were going down, and this morning it dropped as share markets were starting to go back out. Perfectly normal, and it's kind of why we have it in the portfolio. And very happy to have it in the portfolio, but not too much because it doesn't produce income. Onto the property markets and continued good news. The market's starting to flatten a bit. This is to the end of December. So you'll see slightly smaller changes on the monthly values. Monthly values are notoriously fickle in real estate. So the pace of growth is slowing, and in some areas you can feel it tapering off, but still a spectacular year. The change year on year, you'll see 25% in Sydney, 15% in Melbourne, 28% Brisbane, including the Gold Coast, slightly lower in Perth at 13%, but a very big year last year for property. I'll talk a bit about the predictions in a minute. But yeah, feel like it's slowing. But keep in mind, there's lots of property markets. I love this chart from Michael Yardney, which shows the reality of a property cycle. And this is a model, so they're not predictable, but that it goes up in the long run over time, but in the short run, it goes through these wild booms, followed by a leveling off, sometimes a correction. We're certainly got to be somewhere near the top of the hill in places like Sydney, Sunshine Coast, where I'm sitting, where the market's been spectacular for the last little while. It shouldn't stop that long-term uptrend, but we might be in for a break. But not all markets are the same, and I'll talk about that in a minute. And also beware of predictions. Here's Nick Lenehan from the AFR with a headline, "House Price Growth to Slow Before Falling in 2023. So all of a sudden, every bank economist and every bit of media is saying we're only going to get about 5% growth in the property market this year, then it's going to drop 10% in 2023. Once again, I would point out none of these people are responsible for actually managing people's money. The last time they made such a unanimous prediction was at the start of COVID, where they predicted the Australian property market would drop by about 20%. Got it completely 180 degrees wrong. So be careful of media and economist forecasts. One, they tend to all read the same stuff, so they're all predicting the same things. They may well be right, by the way. So I'm not saying they're going to be wrong. That may well be how it plays out, but who knows? And when they all agree, often things don't do that. Yeah, house prices might fall this year, 2022, before rising in 23. Make your decisions based on your own planning, your own situations, and not all markets are equal. I'm showing this chart again. I showed it last month, but you'll see this is from the RBA's chart pack, and it shows residential property prices for the capital cities, but all brought back to be common with 2011-12 as 100. So it's an index. So if you say, assuming they're all 100 at that point, what have they all done? And you'll see top of the tree, Sydney is very, very different to bottom of the market than Darwin. Darwin's still below where it was in 2011-12. Perth's marginally above. Sydney and Hobart have done spectacularly as well, followed by Melbourne and Canberra, and then Brisbane and Adelaide languishing, Perth even more so. And that's why we're comfortable for our younger clients who are looking at property investing with a 10 to 20 year window. There's better opportunity, predominantly around Brisbane, around Adelaide, around Perth, who are just at different times of the cycle. Now, I'm not saying that investing in Sydney or Melbourne or places that are more mature is going to be a bad thing. Over 10 to 20 years, you'll probably do incredibly well. But there's a chance that they flatline to flatten out a bit. Like Sydney did, you'll see from 17 through to 19, Sydney pulled back a little bit before taking off again. And this chart doesn't go back about, but Sydney did that in the early 2000s as well. So there's likely to be a time where they go sideways, but once again, they may not. If it all gets down to supply and demand, we've got some very unusual times coming up. We're about to open our borders. We're doing it very slowly at the moment. It's not to the broader public, but returning Australians and very selected people. But as immigration comes back in the next few years, we may see that we haven't built enough places, and we might see a bit more pressure. It's hard to tell, but once again, just careful selection, long-term approach, be an investor, not a trader, and you'll win in the long run. Heron Todd White's property clock still shows everything rising, some of them approaching a peak. But this is a factual thing. This is not a predictive thing. So it just says, obviously, there's a bit of prediction about approaching the peak, but that's normally that the market's slowing down. It's been very little change to that in the last 6 months with everything going up. But just talking to agents, investors, and other people around the country, I feel like it's leveling off a little bit at the moment. But we don't know what's going to happen with interstate immigration as well. As we come out of the lockdown era, it may accelerate. It may actually not. People might decide in Melbourne and Sydney that out of lockdown, it's actually looking good again. So those plans to move to Queensland or whatever get put off. We may not have the flood of people that we expect. Some people who bought properties in Queensland might decide they're going to take the profits and run, which would put pressure on and might bring prices down there as well. So it's a complex beast, a market there. But once again, if you're taking a long-term view, as part of a plan, it's much easier to make decisions and trying to work out what's going to happen next year, which is always pretty unknowable. That leads me to wrap up, as always, with saying that all your investing is best done as part of a real financial plan, which it is for all of you, which is based on your goals and your life. The portfolios are designed to meet that. We take a long-term view. That's why we love our beautiful, boring diversification, getting the right asset allocation and having enough liquidity. We capture the market for most growth stuff through indexing, and we protect against the inevitable short-term volatility like right now through reserves. So every one of our retired clients has enough in reserves to get through these types of downturns without ever having to sell, a growth asset, which is really important. That means we can sit back and relax as long-term investors and hopefully just be entertained by the shenanigans of the media and the market, but not worried. If you're worried, give us a call. As always happy to talk it through. For our younger clients, guess what? Shares are on sale. This is why we love dollar cost averaging and why we're happy to be buying all the way through with your monthly investments. And for some of you, you may want to even consider bringing forward some of your investments. If markets stay down long enough, they might not. In the last few years, every time there's a downturn, it bounces back pretty quickly. Whether this one will or won't will depend on how that tech theme and inflation and interest rates plays out and the perception of the market. We rebalance portfolios at the portfolio level and at the broader account level for you guys regularly, which helps us take advantage. And remember, the only three ways, that the biggest one at risk at the moment is those that would panic and sell during a downturn, or those that have to sell. As I said, none of our clients have to sell because they've got a good plan, they've got the reserves in place. So it's making sure you don't panic and sell. We haven't had any examples of that recently. I haven't had any calls on this one so far. Always happy to talk, but one of the reasons we put this out is so you can get some reassurances. I'm never going to predict what happens next because it's too hard and no one actually knows, and no one that makes predictions publicly actually has a track record of making any money by managing money from those. They love the headlines, and particularly for those that make negative predictions, if they keep making them, they're eventually right to some degree. So a bit like the broken clock that's right twice a day, but that doesn't make them good at managing people's money or actually worth listening to, except for entertainment value. I wish you all the best for the next little while. It's going to be a fascinating year, and hopefully as we open up and get back to some normality, but we've certainly been lucky for most of us in terms of where we live and what life's been like. Hope Christmas, New Year break was good for all of you. Looking forward to seeing you all over the next little while. And yeah, take care. Rob McGregor signing out.